Bismillahirrahmanirrahim. This is the first video on budgetary planning. In this video, we will explain the benefits of budgeting. We will state the essentials of effective budgeting. We will also identify the budgets that comprise the master budget. And finally, we will solve the exercises comprehensively. In the second video, we will talk about the sources for preparing the budgeted income statement. We will explain the principal sections of a cash budget. Please like, subscribe and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below. And for webinar and speakership invites, please send me a message at accountingamir@gmail.com, and accounting is AK. We hope that this video help students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We hope this video helps ACCA, AICPA, CPA and CMA aspirants. We also hope that this video help fresh graduates who have joined the companies and want to refresh their learning of budgetary planning. Let us start with budgetary basics. A budget is an estimation of revenue and expenses over a specified future period of time and is usually compiled and re-evaluated on a periodic basis. Budgets are an integral part of running any business efficiently and effectively. Let us look into budgeting and accounting. Both budgeting and accounting are fiscal systems or processes that involve the planning, allocating, and disbursing of monetary resources. This results in an interrelationship and a need for coordinating between these two fiscal disciplines. Let us talk about the benefits of budgeting. A budget helps to be on top of the finances. It has host of benefits like it gives control over the money, it helps to focus on financial goals, it keeps the company on top of what they are spending, it makes it easier to stay aware of savings and debts, it helps to save for unexpected cost, it makes talking about money with other managers easier, it shows the finance manager where money issues are likely to come from and help to figure out what the company can borrow. Next, we will talk about the essentials of effective budgeting. The essentials of an effective budgeting includes sound forecasting, an adequate, planned and reliable accounting system, efficient organization, formation of budget committee, cleanly defined business policies, availability of standard information, support of top management, good reporting system, and motivation. Next, we will talk about budgeting period. Budget periods are usually 12 months long but may be shorter or longer if appropriate. Next, we will talk about budgeting process. The budgeting process is the process of putting a budget in place. This process involves planning and forecasting. implementing, monitoring and controlling, and finally evaluating the performance of the budget. Accurate sales forecasting is essential for a business house to enable it to produce the required quantity at the right time. Further, it makes the arrangement in advance for raw materials, equipments, labor, etc. Many firms manufacture on the order basis, but in general, every firm produces the material in advance to meet the future demand. Let us elaborate more on sales forecasting. Any forecast can be termed as an indicator of what is likely to happen in a specified future time frame in a particular field. Sales forecasting is the process of estimating future sales. Accurate sales forecasts enable companies to make informed business decisions and predict short-term and long-term performance. It forms a basis of sales budget, production budget, natural budget, etc. The purpose of sales forecasting should be to provide information that you can use to make intelligent business decisions. Factors that are considered for sales forecasting includes competition, changes in technology, government action, factors related to the concern itself. Let us now talk about budgeting and human behavior. A comprehensive budget usually involves all segments of a business. As a result, representatives from each unit are typically included throughout the process. The process is likely to be led by a budget committee consisting of senior level personnel. Such individuals bring valuable insights about all aspects of sales, production, financing, and other phases of operations. Not only are these individuals ideally positioned to provide the best possible information relative to their respective units, but they are also needed to effectively advocate for the opportunities and resource needs within their unit. Let us now talk about participative budgeting. Participative budgeting is a process under which people impacted by a budget are actively involved in the budget creation process. This approach gives lower level managers a greater sense of ownership in the resulting budget. The most common limitation of participative budgeting is that it is time consuming compared to an imposed budget. Since the budget preparation starts from the department level to the top, too much participation may occur that may derail the process. The illustration shows the flow of budget data from lower management to top levels. A long-range budget is a financial plan that extends for more than 1 year into the future. This type of budget typically covers a 5-year period and is focused on the strategic direction of the business. Next, let us talk about master budget. The master budget is the aggregation of all lower level budgets produced by the company's various functional areas and also includes budgeted financial statements, a cash forecast, and a financing plan. A master budget is a set of interrelated budget that constitutes a plan of action for a specified time period, it contains two classes of budgets: operating budgets and financial budgets. So you can see we have the operating budget and we have the financing budget, and we start with the sales budget. Sales budget is the first budget prepared. It is derived from the sales forecast. Every other budget depends on the sales budget. It is prepared by multiplying expected unit sales volume for each product times anticipated unit selling price. And let us solve an illustration regarding on sales budget. Now Hayes Company expects sales volume to be 3000 in the first quarter, with 500 units increase in each succeeding quarter. Prepare the sales budget for the year by quarter based on a sales price of 60 per unit. So the expected unit sales for the first quarter is 3000, and it is going to increase by 500 in each quarter. So it increases by 500, and the total will be 15,000. The unit selling price is 60, so we multiply by 60 for each quarter units, and the total will be 180,000, 210,000, 240,000, 270,000, and the total for the whole year will be 900,000. Next, I have put the same illustration in an Excel sheet in case you find difficult to read my handwriting. And next we will look into the production budget. As you can see, we start with the sales budget, and after the sales budget we have the production budget. Production budget shows units that must be produced to meet anticipated sales. It is derived from sales budget plus the desired change in ending finished goods inventory. Now this is something of interest in production budget, the ending finished goods inventory. And the formula for determining the required production in units is budgeted sales plus desired ending finished goods in units minus beginning finished goods in units. So let us look into an illustration again, and we are going to solve it. Hayes Company believes it can meet future sales requirements by maintaining an ending inventory to 20% of the next quarter's budgeted sales volume. Prepare the production budget. So the production budget provides the basis for the budgeted cost for each manufacturing cost element, and the expected unit sales is going to come from the sales budget we already have prepared. We have the units 3000, 3500, 4500. So we have it from the sales budget, the expected unit sales 3000, 3500, 4000, and 4500. Then it says the ending inventory they want equal to 20% of next quarter's budgeted sales volume. So 20% of 3,500 will be 700. 20% for the next quarter will be 800. Then we have 900. Here you see we are going to assume the figure in the fourth quarter it is 4,500. That means in the first quarter of 2015 the expected unit sales will be 5,000 and 20% of 5,000 will be 1,000. So the total required units will be 3,700, 4,300, 4,900 and 5,500. And then as you can recall the formula, we have to subtract the beginning finished goods units. Now the beginning finished goods units for the first quarter will be the ending finished goods inventory of for the year 2013 quarter number 4. Now because the sales is expected to increase by 3,000 by 500 in each quarter, that means that the expected unit sales in the fourth quarter for the year 2013 will be 2,500. And the desired ending finished goods inventory as it is given here is 20% of the next quarter. So 20% of 3,000 is going to be 600. So that's how we get this value over here. And then again we will continue. It is going to be so 20%. So over here it will be 700, 800 and 900. So we have to subtract. So after subtraction we are going to have the production in units of 3,100 units, 3,600, 4,100 and 4,600. Next we will look into, you see, after the sales budget, after the production budget, we are going to prepare the direct material budget. So let us look into how to go for the direct material budget. Now direct material budget shows both the quantity and cost of direct material to be purchased, and the formula for direct material quantity is given over here. And we are going to solve an illustration on direct material budget. Hayes Company maintains an ending inventory of raw material equal to 10% of next quarter's production requirement. So we are going to have the units to be produced from the production budget, and the units required was 3,100. These are the units to be produced. So we simply copy these values here: 3,100, 3,600, 4,100 and 4,600. Now the manufacturer of required 2 pounds of raw material for each unit. So we multiply by 2 in each case. So the total pounds required will be 6,200, 7,000, 8,200, and assume that the desired ending direct material amounts to 1,020 for the fourth quarter. So for the fourth quarter, sorry, first of all let me calculate. and that is going to be 9200. So desired ending inventory, as it is given in the question, is 10% of the next quarter's production requirement. So 10% of next quarter, this should be 7200. So this will be 10% of the next quarter. So 10% of 7200 is 720, 820, 920. And for the last quarter, they say assume that the desired ending direct material amount to 1020 pounds for the fourth quarter, thus that becomes 1020. So the total will be, simply sum it up, 6920, 8020, 900, 9120, 10,220. Then we are going to subtract the beginning direct material, and again that is going to be 10% of these values. So 10% will be 620, 720, 820, and 920. So the direct material purchases will be 6. We are going to subtract these values. So this is 6300, 7300, 8300, and then 9300. And they say the expected cost per pound is 4. So we are going to multiply by 4 in each case, and that will give us 25,200, 29,200, 33,200, 37,200, and the total will be 124,800. I have put the solution in an Excel sheet over here as well, in case you find difficult to read my handwriting. And after preparing the direct material budget, the next budget to be prepared is the direct labor budget. And direct labor budget shows both the quantity of hours and cost of direct labor necessary to meet production requirements, critical in maintaining a labor force that can be expected production. The total direct labor cost formula is given over here. Units to be produced times direct labor time per unit time times direct labor cost per hour, and this is equal to total direct labor cost. And once again we are going to solve an illustration on direct labor budget. At Hayes Company, 2 hours of direct labor are required to produce each unit of finished goods. The anticipated hourly wages are 10. So once again we are going to take the units to be produced from the production budget, that is 3,100, 3,600, 4,100, and 4,600. The direct labor is 2 hours, so we will multiply by 2 in each case. So that gives us 6,200, 7,200, 8,200, and 9,200. The direct labor cost per unit is given to us as 10. So we will now multiply it by 10. And this will be equal to 62,000, 72,000, 82,000 and 92,000, and the total for labor cost for the year budgeted labor cost will be 308,000. Once again, I have put this in an Excel sheet for your convenience to read. And after preparing the direct material budget, the next budget to be prepared is manufacturing overhead budget. Now, manufacturing overhead budget shows the expected manufacturing overhead cost for the budget period. It distinguishes between fixed and variable overhead. We will look into an example about it. And now let us solve an illustration on manufacturing overhead. Hayes Company expect variable cost to fluctuate with the production volume. So first of all, we are going to have the variable cost, and we have the direct labor hours from the budgeted part, direct labor hour budget, 62, 6,200, 7,200, 8,200 and 7,200. So you can see over here, these are the total direct labor hours. So we have simply copied them over here. And these are, let us look into the question now. On the basis of the following rate per direct labor hours. So that's why we have put these direct labor hours. Indirect material at the rate of 1. So 1 times 6,200 is 6,200. So we simply multiply the direct labor by 1 and 7,200. This will be 8,200, 9,200, and the total will be 30,800. Then indirect labor is 1.4. So again, direct labor times 1.4. So that will be 8,680, 10,080, 11,480, 12,880 and 43,120. Next, the maintenance cost is 0.2. We have utilities as 0.4 over here. So once again, we will multiply the direct labor hour by 0.4. So that will give us 2,480, 2,880, 3,280, 3,680, 12,320. And then we have the maintenance of 0.2. So we multiply this by 0.2. So 12,000, 1,240, 1,440, 1,640, 1,840, and the total will be 6,160. So the total variable cost for the first quarter will be 18,600. For the second quarter, it will be 21,600. For the third quarter, 24,600, 27,600, and for the year, it will be 92,400. Thus, for Hayes also recognizes that some maintenance cost is fixed. The amount of reported for fixed cost are assumed for our example. So the values that you are getting over here, these are assumed. They have just put the value, and you know that fixed costs do not change. So that's why the fixed cost for supervisory salary is the same for each quarter. Depreciation remains the same, property taxes remain the same, maintenance they remain the same. So that's how we calculate. So we have the total variable cost and we have the total fixed cost, and the total manufacturing cost will be sum of variable cost and fixed cost, that will be 57,100, 60,100, 63,100, 66,100 and 246,400. There may be some minor calculation mistakes, so don't worry for that. And manufacturing overhead rate per direct labor hour, so we have the total cost of 246,400 and the total direct labor hour is 30,800. So once you divide, this will be equal to 8. So manufacturing overhead rate per direct labor hour will be 8. Once again, you can see the calculations are put in an Excel sheet for your convenience to read. And finally, we will talk about selling and administrative expense budget. Now, selling and administrative expense budget makes projection of anticipated operating expenses and distinguishes between fixed and variable cost. And again, we are going to solve an illustration on selling and administrative expense budget. Now, Hayes Company combines its operating expenses into one budget. The selling and administrative expense budget, in this case, the variable expense rates per unit of sales are sales commission. So first of all, we have the budgeted sales from the sales budget we have already prepared, and now we are going to allocate the different variable expenses. Like we have sales commission, and the sales commission is 3. So we will multiply this by 3, that will give us 9,000, 10,500, 12,000 and 13,500. So the total will be 45,000. Sorry, I should have put here 9,000, 10,500, 12,000, 13,500 and 45,000. Let me $9,000, and this will be 10,500, and this is 12,000, 13,500 and the total will be 45,000. Next, we have $1 for freight out. So we have the same 1 times 1. This will be here. It will be times 3, and this is times 1. So this is 3,000, 3,500, 4,000, 4,500, and the total will be 15,000. So the total variable cost will be 12,000, 14,000, 16,000, 18,000, and the total will be 60,000. Now once again, you can see that the total fixed costs are assume that they are given to us. So the total selling and administrative cost, there is a mistake over here. It cannot be 30,000. It should be a summation of 12 plus 30, that will make 42, and 14 plus 30 will be 44, 16 plus 30 will be 46, 18 plus 30 will be 48, and 60 plus 120 will be 180,000. Sorry for that. I have put this again in an Excel sheet. Yes, and then you see we have the correct values over here. You can check the correct values, as these calculations are by Excel. You can also note that the fixed cost that we have put over here, these are the assumed values in the illustration. And now we are going to solve some exercises. Noble Company classifies its selling and administrative expense budget into variable and fixed component. Variable expenses are expected to be 22,000 in the first quarter and 4,000 increment. So in the first quarter we have 22 and it increases by 4,000, so it will be becoming 26, then it will be 30, then it will be 34, and the total will be 112,000. The fixed expenses are expected to be 40,000, so fixed expenses remain the same, each quarter they are not increasing, and the total will be 160,000. And when you total this will be 62, 66, 70, 74, and 272,000. I have put this again in an Excel sheet for your, if you find difficult to read my handwriting. Next, let us look into one more illustration. And Atlanta Company is preparing its manufacturing overhead budget for the year 2014. Relevant data consist of the following units to be produced: 10,000, 12,000, 14,000, and 16,000. Variable overhead cost per direct labor hour. Okay, direct labor hour is 1.5 hours per unit. Variable overhead cost per direct labor hour, indirect material is 0.8, indirect labor 1.2, and maintenance is 0.5. So first of all, we are going to allocate the indirect material, and the first quarter we have 10,000, second is 12, third is 14, and fourth is 16. So indirect material will be 10,000 times the 1.5 times 0.8. So 10,000 times 1.5 times 0.8 will be equal to 12,000. For the second quarter, it will be 12,000 times 1.5 times 0.8, that is 14,400. For the third quarter, again 14,000 times 1.5 times 0.8, so that will be 16,800 and 19,200. So the total will be 62,400. For indirect labor, again we are going to have 10,000 times 1.5, and indirect labor is 1.2. So it will be 1.5 times 1.2 times 10,000, so that will be 18,000. Second quarter will be 21,600. Third quarter will be 25,200. Fourth quarter will be 28,800, and the total will be 93,600. For maintenance, it is 0.5. So 1.5 times 0.5 times 10,000, that will be 7,500. 12,000 times 1.5 times 0.5 will be 9,000. For the third quarter, again 10,500, and the fourth quarter it will be 12,000, and the total will be 39,000. So now we can sum up so the total variable cost for the first quarter will be 37,500. Second quarter will be 45,000. Third quarter will be 52,500, 60,000, and 195,000. Okay. The fixed overhead cost per quarter supervisory salaries are 35,000. So fixed costs are going to be fixed, that is 35 for each quarter. And the total will be 140,000. Depreciation 15,000. So 15,000 again for each quarter, and that is equal to 60. Then we have maintenance of 12,000 each quarter, that will be 48. So the total fixed cost will be, for the first quarter is 62, second is again 62, third is 62, fourth is 62, and the total will be 248,000. So now the total manufacturing cost will be the total variable cost plus total fixed cost. So the total manufacturing cost is 99,500. Second quarter will be 107,000. Third will be 114,500. Fourth will be 122, and the total for the year will be 443. Direct labor hours is given to us 10,000, sorry, 1.5. So that means 1.5 times 10,000, that will be equal to 15,000. It is 1.5. And then the second will be 18,000. Third will be 21, and fourth will be 24, and the total will be 78. So the manufacturing overhead rate will be the total manufacturing overhead divided by the total direct labor hours, that will be equal to 5.68. Once again, I have put this illustration in an Excel sheet in case you find difficult to read my handwriting. Let us look into one more illustration. And Duncan Company combines its operating expenses for budget purposes in a selling and administrative expense budget for the first 6 months of 2014, and the following data are available. Sales is 20,000 and 22,000, so 20,000 and 22,000. These are the sales in units. The variable cost per dollar of sales commission is 5%. So sales commission is 5%. Uh, Delivery expenses are 2% and advertising is 4%. Fixed costs per quarter are 10,000, 8,000, 4,200, and insurance and all. Unit selling price is 20. So the variable cost for the sales commission will be 20,000 for the first quarter, and the sales commission is 5%, and the unit selling price is 20. So 5% of 20,000 times 20, the selling price per unit, that will give us again, oh, that is interesting, 20,000, and this will be 22,000, that is 42,000. Okay, then 5%. That's how we get this 20,000. Then we have delivery expense, and again the delivery expense is 2%. So 20,000 times 2% times selling price per unit, that is 20. So that makes 8,000 and 8,800, and the total will be 16,800. Then we have the advertising expense, and that is 4%. So 4%, 20,000 times 4% times 20, that is 16,000 and 17,600, and the total will be 33,600. So the total variable cost will be 44,000, 48,400, and 92,400. Then we have the fixed expenses, where they say sales salaries are 10,000, so they are fixed, they don't change. For each quarter, that is 10, and that makes 20. Then we have depreciation of 4,200 for each quarter, that makes 8,400. Sorry, depreciation is 8,000. So 8,000 for both quarter, that makes 16,000. Then we have insurance. We have okay, so we have sales salaries and we have office salaries. Sorry, these are office salaries, 8,000 and 8,000. Depreciation is 4,200, that makes 8,400. Insurance is 1,500 and 1,500, that makes 3,000. Then we have utilities of 800 and 800, that makes 1,600. And then repair expense are 500, and that makes 1,000. So the total will be 25,000 for each quarter, and the total will be 50,000. The total selling and administrative expenses will be the total variable cost plus total fixed cost. So that is 69 and 73,400, and the total will be 142,400. Once again, I have put this illustration in an Excel sheet in case you find difficult to read my handwriting. And this completes our discussion on first part of budgetary planning. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question regarding this session, then please don't hesitate to ask in the comment box or by email, and inshallah I will reply you back. Thank you so much and happy learning.